The Oval Office is in chaos. Trump slams a red folder on the desk and shouts, "They have to give us magnets or we hit them with 200% tariffs." But the magnets aren't ordinary. They're the rare earth lifeline for U.S. fighter jets, electric cars, and missiles. And Beijing controls nearly 90% of global supply. Within hours, China strikes back, strengthening its currency, cornering U.S. assets, and leaving Wall Street's trillion-dollar bubble exposed. The question isn't whether a trade war is coming. It's whether America still has any cards left to play. Behind Trump's bravado sits Treasury Secretary Scott Bessent, pushing a very different gamble. In his mind, the U.S. bond market can be rescued not with factories or exports, but with digital tokens. Stablecoin, he argues, will become a new artery of demand for U.S. treasuries. This groundbreaking technology will buttress the dollar's status as a global reserve currency, Bessent said in July, framing stablecoins as the saviors of the bond market. Goldman Sachs went further, predicting a $1 trillion stablecoin boom, citing Visa's estimate of $240 trillion in annual payment flows. The idea, every digital dollar backed by treasuries creates artificial demand for U.S. debt. But here lies the fracture. Propping up a currency through financial engineering is not the same as protecting its role in trade. Beijing knows this, and Xi Jinping is moving on a terrain that matters: commodities and exports. Just weeks ago, China's central bank set the yuan's daily fixing at a 9-month high. At first glance, it looks counterintuitive. Conventional wisdom says exporters thrive on a weaker currency. Yet Beijing deliberately strengthens the yuan even while Trump ratchets tariffs higher. Why? The hypothesis that a stronger yuan undermines exports collapses when input costs are factored in. China still imports Russian oil and commodities at steep discounts, cushioning its factories. A 2 to 3% appreciation in the yuan barely dents competitiveness. But the signal it sends is profound. Global investors see higher returns in yuan assets, not dollars. Goldman Sachs calculated that every 1% rise in the yuan can boost Chinese equities by 3%. The capital inflow effect outweighs the export price penalty. Beijing is cornering U.S. assets not through tanks or tariffs, but through a revaluation that makes Wall Street look fragile. Trump's tariffs, meanwhile, are multiplying pain inside the United States. Effective rates are now about 17%, according to the Peterson Institute, for industries relying on imported inputs like semiconductors from Korea, electronics from China, and chemicals from India. Costs have jumped between 15 to 20%. The contradiction is clear. Tariffs were supposed to revive U.S. manufacturing, yet they actually magnify costs when paired with falling dollar. The dollar slide of nearly 10% this year, Bloomberg reports, has already erased gains for foreign investors in U.S. equities. An S&P rally of 9% just disappears once you adjust for currency losses. This is the so-called double whammy. Economists warn that protectionism raises costs while currency weakness deters capital inflows. China, by contrast, strengthens its own currency to attract money. Meanwhile, U.S. margin debt, the borrowed cash fueling Wall Street speculation, just crossed $1 trillion in July. According to FINRA, a market driven by leverage looks resilient only on the way up. The moment capital starts to exit, debt turns from fuel into fire. Beijing understands its fragility. By holding the yuan firm, it doesn't even need to sell a single U.S. treasury to spook investors. Money flees naturally, chasing higher yields and stronger currency protection in Shanghai instead of New York. Trump insists America still holds the trump card: Boeing. 200 of their planes were unable to fly because we were not giving them Boeing parts, he told reporters after meeting South Korea's president. The implication is leverage. Deny China Boeing components and Beijing will fold. But look closer. Airbus, headquartered in Europe, is already negotiating massive new contracts with Chinese carriers. Comac, China's state-backed aircraft maker, is rolling out its C919 jet with deliveries already underway. Denying parts in the short run simply speeds up Beijing's shift toward Airbus and domestic alternatives. What Trump frames as leverage may actually be a catalyst for the erosion of Boeing's duopoly. Trump's tariff threats and aviation bluster are meant to show dominance, yet they highlight dependency. Rare earths and magnets flow only one way, from China outward. Airplane parts, by contrast, have substitutes. In negotiation theory, the side that can walk away holds power. Beijing can withhold magnets without undermining its economy. Washington, on the other hand, cannot halt rare earth imports without crippling its supply chains. The imbalance is structural. And now, the new question emerges. If Beijing can squeeze rare earths, strengthen its currency, and pull capital inflows all at once, where does U.S. leverage actually lie? The narrative turns here not on whether Trump can impose tariffs, but on whether the U.S. still has credible instruments of pressure. Look at Brazil. The U.S. could have partnered with Brasilia to develop the world's second-largest rare earth reserves. Roughly 20% of global deposits lie in Brazilian soil, a potential Western alternative to China's dominance. Instead, Washington imposed tariffs of up to 50% on Brazilian exports. Investment dried up and the mines never scaled. By undermining its own allies, the U.S. blocked the exits while Beijing tightened the noose. Today, Reuters reports that China controls over 60% of global rare earth resources and 90% of refining capacity. Brazil could have been the counterweight. Instead, it is China's refining industry that benefits. Meanwhile, Besant doubles down on his stablecoin pitch. The Genius Act, passed in July, aligns state and federal frameworks for crypto tokens backed by treasuries. Circle's USDC, the largest dollar-backed stablecoin, is projected by Goldman Sachs to grow 40% annually through 2027, adding $77 billion in market cap. But critics point out the flaw. Stablecoins recycle existing dollar demand. They don't create new trade flows. It mostly redistributes money rather than increasing the net demand for debt. One Financial Times analysis noted, Beijing's bet on strengthening the yuan, by contrast, alters trade flows and investment behavior globally. Washington is playing with digital plumbing. China is adjusting the price of money itself. U.S. interest payments on the national debt have surged to $1.2 trillion annually, according to Congressional Budget Office. That figure alone now exceeds what Washington spends on defense. Financing costs are not abstract. They compete directly with industrial policy and defense budgets. Besant's hope that crypto demand props up treasury auctions looks increasingly like a Band-Aid on a hemorrhage. The paradox is stark. The more Washington leans on financial engineering, the more Beijing leverages physical commodities and trade realities. Back in Beijing, Xi's calculus is not without risks. A stronger yuan raises domestic pressure, especially on small exporters with thin margins. Yet the timing aligns with global disillusionment toward the dollar. In June, U.S. allies, including Japan and India, reduced treasury holdings. Bloomberg data shows this as part of a broader diversification into gold and alternative currencies. China seized that moment, positioning its financial system as a stable alternative. Goldman analysts noted that a 2% appreciation in the yuan this summer coincided with a 7% jump in Chinese equity inflows. For global investors, the message is pragmatic. Money goes where returns are higher and currencies more stable. Nationalist rhetoric plays little role in asset allocation. And so, the ironies stack. Trump's tariffs, designed to force China into concessions, are instead making Chinese goods more attractive to third countries. By raising U.S. import costs, Washington indirectly sustains Beijing's export market share. Airbus gains Chinese contracts because of U.S. aviation threats. Brazil's rare earth mines remain undeveloped because of U.S. tariffs, leaving Beijing's grip unchallenged. Each American move intended as leverage becomes an accelerant for China's alternatives. The crescendo comes with the rare earths themselves. In July, China's exports of rare earth magnets to the United States surged 660% month-on-month, according to customs data. Volumes then rose another 76% in August. On paper, this looks like relief. The supply crunch eased. But if you look at the fine print, Beijing's new regulations force monthly reporting of strategic material flows, giving the state even tighter visibility and control. The spigot can open wide one month and close the next. Dependence deepens, not shrinks. Trump's warning of 200% tariffs cannot alter this asymmetry. What begins as a tariff standoff escalates into a systemic repositioning. The dollar weakens as investors pull out. The yuan strengthens to draw them in. Wall Street floats on $1 trillion of borrowed money, vulnerable to outflows. Chinese equities gain on currency appreciation and capital inflows. U.S. rare earth supply chains remain exposed, while potential alternatives in Brazil stay dormant. Besant bets on stablecoins, but they redirect existing flows rather than creating new ones. America, long the architect of global finance, now leans on digital tokens and debt recycling to sustain its reserve status. China, long caricatured as an export addict, deliberately strengthens its currency and attracts foreign capital. Trump threatens tariffs as leverage, yet tariffs have already boxed in U.S. industry. Besson promises crypto salvation, yet crypto demand may only expose the fragility of U.S. debt markets. She does not need to escalate militarily. The revaluation of his currency does the work. What looks like a trade war over magnets and airplane parts is, in fact, a systemic inversion. The United States frames itself as creditor, but it is the debtor. It threatens tariffs, but those tariffs punish its own consumers. It warns of leverage over aviation, but substitutes exist in Europe. Is this Trump winning the tariff war?